introduce myself?
Tom, a lot of people didn't. We're going to do that right after. You'll certainly have time. I'll
No
make
problem.
it right after.
Okay.
Well, okay,
David,
well,
can you
go
see
ahead.
my screen?
I can. Yes. And just let me just welcome everybody to this month's WITI LinkSV session where we look at where the money went last month, who should we work for, who should we partner with, who should we sell to, who should we buy from. Maybe some AI stuff happening last month, Don, in the first half of the year. Call me a psychic, but I'll turn it over to you.
Okay, thank you, David. My slideshow today is I'll say brief. I've been having AI and processing problems, but we've got all the details, so we'll talk it through. Stop that. Okay, so the first half of 2025 saw a tremendous surge in venture capital. And no surprise, most of that went towards AI. And that's what we'll be looking at today. So it's good to take a historical perspective. Looking back at 2021, that was our zero interest period time. And there were deals going 24 hours a day, 12 months a year. That was the surge in funding. The following years, it's gone down, came back a little last year. The first half of this year, it was up by over 75%. And we're on track US-wide to come very close to the 2021 peak. In the Valley, we're actually ahead of 2021. And that's no surprise because a lot of the AI funding that's going on is coming directly here. 73% of US funding came in Q1. Q2 saw it drop to 64. That's primarily because of that $40 billion round that OpenAI did. So we're on track for a very productive funding year, albeit going to AI companies. Now, for us, for the first half, it was 104.7 billion. That's out of 164 billion US wide. But for us, you can see the heavy dependence on AI. A lot of this money is going into it. And it was particularly high in the first half. Again, not just OpenAI, they had that $40 billion round, but there were many, many what we call mega deals, hundreds of millions of dollars going to a single company in a single round. Now, just perspective, when the AI funding really started to blow up last year, the majority of the big rounds were going to what we'll call the frontier and foundational companies, the OpenAI, the Anthropic, and that has continued, obviously. I mean, yesterday OpenAI announced that they have just pulled in another 8.3 billion. But what we've seen over the last year and into this year is that investment now has spread first from the frontier companies to tools around the frontier companies, then to tools to optimize the tools, and then to take the frontier companies, the LLMs, and start diversifying those so that we have vertical LLMs, we have task-oriented LLMs, we have IoT LLMs. LLMs are not quite commodity, but certainly close to it. So on the back end of the venture funding that's going on is a tremendous amount of infrastructure. spending going on. And of course, this all goes down into many of the startups that have been formed around AI infrastructure. But take a look at some of these numbers. For Microsoft, Amazon, 100 billion. Actually, Amazon is more than 100 billion. Alphabet, 85. Meta has upped theirs since the beginning of the year. They're now saying they'll spend as much as 72 billion. And of course, outside of the big five, you have OpenAI that has already announced they'll put in at least 13.8 billion, as much as 28 billion. And a lot of this is going towards Stargate, particularly the difference between the 13 and the 28. The Stargate project announced earlier this year 500 billion. Now, OpenAI and SoftBank were the two leading figures there, but their intent is to pull in mega donors. That includes the Saudis, that includes many of the big infrastructure companies. Google has said they'll play in that. It's interesting though, because Stargate right now is struggling. They keep backing up what they say they'll be able to do this year, and I think they have now downsized to one data center this year. I believe that's in Texas. And they continue to push out the dates for the rest of the funding. Some of that is apparently due to differences between OpenAI and SoftBank about who's doing what, who's getting credit for what, who's going to be paying for what. Interesting enough, even though OpenAI has, on the face of it, been the leading push for Stargate, they've announced they make additional what's happening and status updates. SoftBank, who had originally intended to, and has not withdrawn yet, invest up to 20 billion in this, if not more. They own the Stargate trademark. So they've been quiet in the background. We'll see where that's going to go over the next months. Apple is one of the big five. I don't mention them simply because they right now are behind in terms of their AI development. They certainly will be out there. They certainly have the cash to spend on infrastructure, but they are not front and center immediately. So let's talk about the other end of things, where the money comes from, and VC fundraising. According to PitchBook, there was something around the amount of 300 billion in dry powder end of June. The fund sizes that are being raised continue to get bigger. The smaller funds, the emerging managers, at least in the PitchBook and CB Insights, the other industry analysts report, are having a hard time raising their second and their third funds. But the companies like A16Z, General Catalyst, the names that have been around for many years, continue to raise new funds, and they continue to be big funds. The largest fund is from Andreessen. They announced that they would be raising this a couple of months ago. It's supposed to be a 20 billion fund. We have not heard that they've closed it yet. But the size of funds, of course, it's a concern for the smaller companies, because if you've got a huge fund, you got to write a big check. And that drives the size of rounds, that drives the availability of competition for rounds. So that's something we'll be looking at. 33% of the venture capital deployed so far this year, 1/3 has come from the 6 largest funds. And that is sort of a follow-up on, let me see if we have that next. On what we saw last year, which was, 2024, 76 billion was raised, but 75% of that was raised by just 30 companies. 50% by just 9 companies. So the funds are going to continue, it looks like, to get bigger. And we can expect to see larger rounds from those funds, and again, them taking up more of the open deals. The other item on there, I think I missed that one. Yeah, PitchBook reports something along the line of 18% of dry powder only was deployed in 2024. So we got a lot of capital out there that is waiting to be deployed. And that goes back even to funds that were put together back in 2020 and 2021. A good percentage of those have not yet been deployed, much less fully deployed. Okay, let's talk about the impact on the startups that are out there raising funds. And it's one set of impacts on the AI companies. It's a separate set on the non-AI companies. Of course, if you're a non-AI company right now, you're probably going to have a hard time raising funds in general. And if you're simply AI washing, you're going to be found out right away and taken out of the running. For AI companies, round sizes are up. Valuations are up. The note that will be one of the notes we'll be publishing in the Pulse today, speaking of valuations and how frothy they are getting, OpenAI is now doing a tender offer for their existing employees and potentially for their early investors that are interested. And it's at a 500 billion valuation, which is an increase of 200 billion from the valuation they got back in March. So this all ripples down. We are seeing larger valuations in the AI companies coming out of seed and Series A. The median is up at both levels. And valuations being up is not a good thing, necessarily. It is not a good thing. Both from the investor perspective as well from the startup perspective. The startups sometimes don't realize the impact of the high valuation because on their next round, they're going to have to at least double that, or the next round of investors aren't going to want to get in there. So this is a trend we expect to see continue through the end of the year, being driven largely by the AI valuations. Now, the investor pools are down, and we're seeing this from 2 perspectives. As I mentioned, PitchBook reports that emerging managers are having a hard time getting their next funds in place. And because the larger funds are taking more of the available capital, there's just less competition out there for deals. And it has, raising money is always difficult. We call last year, 2024, just a terrible year, Arctic winter, for the companies that hadn't raised before, that didn't have the right networks, that weren't one of the hot AI companies. And that's going to continue for those companies. From the graduation rate, well, that gets back to valuation, among other things, but companies that are going for Series A right now are graduating at a lower rate than, since 2020. The revenue, the profitability is especially for AI companies, is critical. And many of the AI companies right now are not returning the margins that is expected. One of the hot areas, coding, look at Cursor and AnySphere. They are reported to be running at negative margins. This SVB latest report says that on the median Series A company, AI company, they're spending $5 to bring in every $1 of revenue. Now, even though they've raised billions of dollars, or hundreds of millions of dollars, that's not going to go far. And now the startups, particularly in the AI arena, have another worry, and that is back to the frontier model companies. Now, this is the OpenAI, this is the Anthropic, Safe Superintelligence. There's probably 5 or 6 big ones. Most of them got in and said that they would be putting out products, didn't specify where they were going. And since the point they released their very first product, have been diversifying into areas that startups are in. So your Cursor, your AnySphere, there's 6 or 7 in this arena, are now facing competition from Google, from Anthropic, Claude Codes, from OpenAI, who now claims that GPT-5 is the best coder out there. And of course, the startups, most of them are using models from the frontier model companies. So you're competing with your suppliers. So this makes for a challenging outlook for the AI companies from a going forward, reaching profitability and moving to exit. The non-AI companies, well, if they get the funding, then they're also dealing with expectations that they may not be able to meet. And this all goes back to that graduation rate. Let's go ahead now. Okay. So exits and acquisitions. This has been a sore point in the Valley since 21. End of 22, the IPO market disappeared. And mergers and acquisitions for a couple of years were quiet. They started to pick up last year. They have been very present this year. We've seen 217 acquisitions. Now, a lot of them don't have a disclosed price, but those that did came out to a total of 96 billion. Now, even when the acquisition is for a company out of the area, it's still good for the Valley because almost invariably any sizable company, even on the East Coast, will have local to us investors. And that was certainly true of, as an example, CoreWeave when they did their IPO. So let's talk now about IPOs because it does appear that the IPO market is returning. This is as of the end of Q2. And therefore, you don't see Figma, which is the most successful IPO that we've had this year, actually for the last 2 years. But there is a pretty solid trend for IPOs in the tech arena now, for Chime, for going back to last year, Astera Labs, Reddit, Rubrik. These are all AI-involved IPOs. And those IPOs have done well. Even CoreWeave, which is not a local company, well, it did not pop significantly, has continued to rise slowly and is doing well on the public market right now. So this is a good trend, and certainly expectations now have gone up for the last half of the year that we will see additional tech IPOs. And there are a lot of them waiting to go. There's the head of NASDAQ says that there are more than 100 companies, some who have filed publicly, but a lot who have filed confidentially. They're just waiting for the right time. Figma may convince them that the time is good, and this is going to bring some liquidity back to the valley, and that's good for the investors, it's good for the LPs, and it's good for startups. There's a virtuous circle that happens when we get that level of liquidity, and new startups are launched, new funds are raised, investors are happy, and it makes it easier, certainly on the startups. Going in the wrong direction here. But this is an interesting phenomena. And it's one of the reasons that we haven't seen acquisitions in AI at the level we expected to. In the past, you've got your big five, your Google, Microsoft, OpenAI, Amazon, Meta. I don't have Apple on here because they have not been participating actively, but in the past, there's been, rather than develop themselves, they'll acquire. That slowed down back in 23, 24 for a variety of reasons, including regulatory. You may remember that Figma was going to be acquired by Adobe, and that didn't happen due to regulatory pushback. But starting a year and a half ago, Google, Microsoft, OpenAI, Amazon, and Meta all got into what we're calling a reverse acqui-hire. And what that nice little term means is rather than buying a company, they take the top talent, they hire the top talent away, they pay whatever money is necessary to quiet the investors. They don't necessarily make the company whole, but they then have their own team of seasoned AI researchers and engineers. And as a couple of industry pundits have pointed out, it's a lot faster to buy a team like that than it is to build a team. So all of the big five have taken advantage of that. And that got escalated, really escalated, when Meta decided that they were behind, that they needed to catch up, they needed to invest whatever money was necessary in order to get current, get ahead. They started what they call the Meta Super Intelligence Labs. And they started by going to Scale AI, one of the bigger data processors, and hiring away their CEO, Alexander Wang, to head up their superintelligence labs. They paid the company $14.3 billion. Oh, we didn't pay it. I'm sorry. They invested $14.3 billion for 49% of Scale. And they then Meta also hired on the other key engineers that were part of Scale. And what didn't sit well with the industry certainly is that the vast majority of that money went to the engineers who were being hired on from Scale to Meta and the investors who had invested. They pretty much left a shell of a company, which was then purchased by Cognition. But this hiring of talent, IP, buying the IP, rather than acquiring the company, has just become commonplace in the AI arena. The Meta push with Scale escalated compensation packages to a admittedly ridiculous level. Meta aggressively went after OpenAI, um, Anthropic, Safe Superintelligence, and Mira Murati's startup with packages that started at $1 million. Some key individuals were actually given packages, 3-year compensation packages up to 300 million. That, of course, ignited issues over at OpenAI, who had to raise their compensation. This is now gone on. OpenAI hired away some of Apple's engineers. Microsoft has hired away some of OpenAI's engineers. It's going to continue. And I can just tell you that the talent costs for AI researchers, of course, these are the top, the cream of the cream, but the talent costs have skyrocketed. And, it just underlines the intense competition we have between, if you're starting an AI company, and big tech. It's not just the products that you're putting out, it's also the people that you depend on that are part of your company. Okay, let me exit this and stop sharing here. And let me just fill in a few. So this information comes from the research that Bob and I do on a daily basis as part of putting out the Pulse of the Valley. That's our weekday newsletter on fundings, on M&A, new startups, people moving from company to company, and investors, new funds and investors who are moving from investor to company or company back to the VC. For entrepreneurs, we have a special $7 membership so you can stay on top of what's happening in the Valley in the funding. And you can ping us. I'll put a link into chat. Ping us for more information on that. And I think that finishes off for this edition. David, it's going to be a really interesting next, well, we're already 1 month into it, 5 months before the end of the year.
It sure will be. I'm going to stop the YouTube.